In October 2025, the U.S. Treasury issued so many short-term bills that it drained nearly $500 billion from a facility most people have never heard of. Within weeks, banks were borrowing directly from the Federal Reserve at levels not seen outside of crisis periods. Markets barely noticed. This is about what happens when the architecture of a financial system is slowly dismantled while everyone is watching something else. It's not a collapse. It's a controlled rewiring. And the people absorbing the risk may not realize they're holding it until it's too late. For the past 18 months, three separate forces have been tightening around the global financial system. Individually, each one is manageable. Together, they're creating pressure in places that most regulators assumed were solved problems. The Federal Reserve is shrinking its balance sheet. The U.S. government is borrowing at historic volumes. And the institutions that used to absorb this stress, the banks, the dealers, the market makers, are operating with thinner margins than at any point since 2019. What makes this different is that it's happening by design. This isn't a surprise. It's policy. But policy has consequences that don't always show up where expected. Start with reserves. In a modern banking system, reserves are the cash that banks hold at the central bank. They're the ultimate liquid asset. When a bank needs to settle a payment, clear a transaction, or meet a regulatory requirement, reserves are what it uses. For over a decade, reserves were abundant. After the 2008 financial crisis, the Federal Reserve flooded the system with liquidity through quantitative easing. By 2014, reserves in the banking system exceeded $2.5 trillion. Banks had more cash than they needed. Funding markets were stable. Short-term rates barely moved. But starting in 2022, the Fed began reversing that process. Quantitative tightening. Bonds matured off the Fed's balance sheet and weren't replaced. Reserves began to decline. By late 2025, reserves had fallen to around $3.2 trillion. Still high by historical standards. But the distribution matters more than the total. Not all banks hold equal reserves. Some institutions are flush. Others operate much closer to their minimums. And when reserves become scarce at the margin, even small disruptions in funding markets can create outsized moves in interest rates. That's what started happening in September. The Secured Overnight Financing Rate, SOFR, is the benchmark that tracks the cost of borrowing cash overnight using Treasury securities as collateral. It's the foundation of the repo market, the multi-trillion-dollar engine that funds dealer balance sheets and keeps Treasury markets liquid. On September 15, 2025, SOFR spiked 9 basis points in a single session. It ended the day trading 18 basis points above the federal funds rate, a gap that shouldn't exist under normal conditions. The catalyst was routine, a corporate tax date, a large Treasury settlement, the kind of calendar events that happen every quarter. But this time, the system didn't absorb it smoothly. Banks that needed cash couldn't find it in the private market at reasonable rates. So they turned to the Federal Reserve's standing repo facility, a backstop designed for exactly this scenario. $1.5 billion borrowed in a day. That number sounds small. It's not the size that matters. It's the fact that it happened at all. Because here's what most people do understand about repo markets. They supposed to be boring. Repo is the plumbing. It's where financial institutions move cash and securities back and forth to manage their day-to-day operations. When repo markets are functioning, rates are stable, liquidity is abundant, and nobody pays attention. When repo markets break, everything else follows. In September 2019, repo rates spiked to 10% overnight. The Fed had to intervene with emergency liquidity. The system had run out of reserves without realizing it. That event forced the Fed to restart balance sheet expansion earlier than planned. The spike in September 2025 wasn't as severe, but it was a signal. The buffers that existed 6 months earlier were gone. At the same time, something else was happening in the background. The U.S. Treasury had been steadily increasing its issuance of short-term bills throughout the summer and fall. The government needed to fund large deficits. Bills are the easiest way to do that. They mature quickly. They're in high demand. And because Treasury bills are considered risk-free, there's always a buyer. But those buyers have to come from somewhere. In this case, they came from money market funds. These funds had been parking cash at the Federal Reserve's overnight reverse repurchase facility, earning a modest but safe return. When Treasury bills started offering slightly higher yields, the funds moved their money. By November, The Fed's reverse repo facility had shrunk from over $2 trillion to just over $500 billion. $400 billion in 6 weeks. That money didn't disappear. It moved into Treasury bills. But in doing so, it removed a critical buffer from the financial system. The reverse repo facility had been acting as a shock absorber. It was cash that wasn't being used, sitting idle at the Fed, ready to be deployed if funding markets tightened. As that facility drained, the cushion disappeared. Now, when a bank needed liquidity, there was less slack in the system to provide it. The private market had to work harder to clear the same transactions. And on days when demand spiked, tax dates, Treasury auctions, month-end settlements, the market couldn't keep up. That's when rates jumped. Most people will never see this directly, but it affects the cost of borrowing across the economy. It shows up in corporate credit spreads, in mortgage rates, in the financing costs that determine whether a leveraged buyout is profitable or a real estate development pencils out. The plumbing doesn't just move money. It prices risk. The problem wasn't just reserves and repo. It was leverage. For years, hedge funds and relative value traders had been using repo markets to fund highly leveraged positions in treasuries. They'd borrow cash against treasury collateral, reinvest that cash into more treasuries, and pocket the spread. It's a low-margin, high-volume strategy that depends entirely on stable, cheap funding. When repo rates are low and predictable, these trades are safe. When repo rates spike, the cost of leverage can wipe out months of profits in a single day. And these funds aren't small. Some of the largest macro hedge funds and quantitative trading firms run treasury positions measured in the hundreds of billions. Their activity provides liquidity to the market, but it also makes the market more fragile. Because when funding gets expensive, these firms have to cut their positions. That means selling treasuries. And when everyone is selling at once, liquidity evaporates. This is the hidden feedback loop. Tight funding forces deleveraging. Deleveraging creates selling pressure. Selling pressure tightens funding further. It hasn't broken yet, but the conditions are aligning. The Federal Reserve knows this. So does the Treasury Department. Their November 2025 stability reports acknowledge the risks explicitly. The Fed's Financial Stability Report describes the banking system as sound and resilient. Capital ratios are at historic highs. Credit quality is strong. But the report also notes that banks are carrying large unrealized losses on their securities portfolios. These losses don't show up in regulatory capital calculations, but they constrain flexibility. A bank with paper losses can't easily raise new capital or take on new risks. It's solvent, but less agile. The report also highlights growing risks in non-bank financial intermediaries, hedge funds, private credit, insurance companies. These institutions now hold a larger share of systemic risk than they did a decade ago. And unlike banks, they're not subject to the same regulatory oversight or liquidity requirements. When stress hits, non-banks feel it first. And because they're deeply interconnected with the rest of the system, through repo funding, through derivatives, through counterparty exposures, their stress propagates quickly. The International Monetary Fund's October 2025 Global Financial Stability Report uses careful language. It describes the current environment as one of apparent calm in a more fragile world. High public debt, large fiscal financing needs, quantitative tightening pulling liquidity out of the system. These factors, the IMF notes, are compressing term premiums and straining bond market liquidity. The IMF doesn't predict a crisis, but it warns that the margin for error is narrower than it appears. A geopolitical shock, a sudden repricing of inflation risk, a large default. Any of these could trigger rapid adjustments in markets that are operating with less spare capacity. The European Central Bank's November review echoes the same themes. Euro area banks are well capitalized. Inflation is back near target, but growth is weak, investment is subdued, and the region remains vulnerable to external shocks. These reports are written in the language of central banking. Calm, technical, balanced. But the message is consistent. The system is stretched. So where is the risk actually sitting? Follow the money. Duration risk, the risk that bond prices fall when interest rates rise, has moved from central banks back onto private balance sheets. For over a decade, the Fed and the ECB absorbed this risk by buying trillions in government bonds. Now, as they step back, private investors have to hold it. Pension funds, insurance companies, asset managers, foreign central banks. They're all holding more interest rate risk than they were 3 years ago. And if rates move unexpectedly, they'll take the losses. Liquidity risk has shifted from a system-wide buffer to fragmented pockets. The Fed's reverse repo facility was a giant pool of deployable cash. Now that pool is draining, and liquidity is distributed unevenly across banks, dealers, and money funds. When stress hits, it's harder to move that liquidity where it's needed. Credit risk is migrating into private credit markets and non-bank lenders. These entities are stepping into spaces that banks have retreated from, offering loans to riskier borrowers at higher rates. Default rates in private credit are rising, though they remain moderate, but the risk is opaque. It's harder to measure, harder to monitor, and harder to contain if it spreads. What makes this moment unusual is not that any single metric looks alarming. It's that multiple pressure points are building simultaneously. Tight reserves, elevated repo rates, large government issuance, non-bank leverage, unrealized losses in bank portfolios, weak growth in Europe, high debt everywhere. Individually, these are manageable, but they're not independent. They interact, and the interactions create nonlinear outcomes. A spike in repo rates forces hedge funds to deleverage. Deleveraging creates Treasury selling. Treasury selling pushes up yields. Higher yields increase unrealized losses for banks. Losses constrain bank balance sheets. Constrained balance sheets reduce market-making capacity. Reduced market-making makes the next shock harder to absorb. This is how systems break, not through a single catastrophic event, but through compounding stress that exceeds the capacity of buffers to absorb it. The standing repo facility was used intermittently throughout October. Cumulative borrowing for the month reached an estimated $110 billion. That's not a crisis. It's a sign that the private market is operating closer to its limits. The facility exists to be used, but repeated use indicates that the baseline has shifted. The system is tighter than it was, and tighter systems are more sensitive to disruptions. This doesn't show up in headlines. Stock markets remain near all-time highs. Credit spreads are stable. Economic growth, while uneven, is positive in most major economies. But the mechanics underneath have changed. The speculative-grade corporate default rate in the U.S. is projected to fall to 3.5% by December 2025. That's down from 5.1% a year earlier. It suggests that credit stress, while present, is not accelerating. But defaults are lagging indicators. They reflect decisions made months or years earlier. What's happening now? Higher funding costs, tighter liquidity, compressed margins, is the leading edge. The stress that hasn't yet translated into visible losses. And that's the nature of systemic risk. It builds quietly. It's dismissed as technical. It's absorbed by buffers until the buffers run out. Then it's not technical anymore. Documents from the Fed, the ECB, and the IMF all suggest that policymakers are aware of these dynamics. They're monitoring funding markets. They're tracking non-bank leverage. They have tools to intervene if necessary. But awareness is not prevention. And intervention is reactive, not proactive. The architecture of the post-2008 financial system was built on abundant liquidity and low rates. That architecture is being dismantled, not recklessly, but deliberately. Central banks are normalizing policy. Governments are funding deficits through market issuance. Banks are operating with less slack. This is the intended outcome of quantitative tightening and fiscal policy. But the transition is not smooth. And the longer it continues, the more fragile the intermediate state becomes. What this means is that the financial system is operating in a fundamentally different regime than it was 3 years ago. Liquidity is scarcer. Leverage is more expensive. Buffers are thinner. And the institutions that absorbed risk in the past, central banks, primarily, are stepping back. That doesn't mean collapse is imminent. It means the margin for error is narrower. And in a system with narrower margins, smaller shocks can have larger effects. Most people won't feel this directly. Not yet. Credit will remain available to those who can afford it. Markets will function most days. The system will look stable from the outside. But the pressure is there, building in the plumbing, accumulating in the balance sheets of institutions that operate in the shadows of the banking system, waiting for the moment when one more shock exceeds the capacity of the remaining buffers to absorb it. The story of September 2025 is not the story of a crisis. It's the story of a system adjusting to a new equilibrium, one where central banks provide less support, where private markets bear more risk, where the cost of capital is higher and the availability of liquidity is less certain. That adjustment is still underway. How it resolves will determine the shape of the financial system for the next decade. For now, the backstops hold. The tools are available. The monitoring is in place. But the trend is clear. And once a system begins tightening, reversing that trend requires either accepting slower growth or returning to policies that created the vulnerabilities in the first place. Neither option is simple, so the adjustment continues, gradually, quietly, until it doesn't.